Hello and welcome to Market Domination. I'm Julie Hyman, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money. Here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
The Israelis have essentially done three things here in their initial attack. One, they did an incredible job decapitating the military leadership of Iran. Number two, they did some damage to one of the major nuclear sites in Natanz. And number three, they essentially did a Ukrainian gambit.
Geopolitical tension is up. Things are getting less certain, not more certain. And as a result, it's not the time to be taking outside risk.
It's typically not long. You've seen it with the attacks in Saudi Arabia a few years ago. And then with the October 7th, this lasts a little bit. You know, I have a friend who always says oil always overshoots, and typically wars and attacks are a good time for you to sell because you get that opportunity to sell into strength.
I mean, this was a gigantic week in crypto legislation. More in the Congress side. The Genius bill, which is about stablecoins, got a cloture vote for a second time in the Senate. And then on top of that, the final big regulator got a hearing in the Senate. Brian Quinten's the CFTC. So it was a gigantic week in crypto legislation.
Stocks are falling with an hour to go in the trading day as Israel's attack on Iran is having repercussions through the global markets. Just want to walk you through quickly some of the reaction that we are seeing, and then we'll get to some of the details here. We are seeing the Dow fall to the lows of the session right now. It is down by nearly 2%, and that's as we are now in real time seeing Iran retaliate against Israel. We've been watching some of those missiles find a mark, some of them being shot down by Israeli forces. So we had seen stocks sort of recover a little bit from their lows, but now back down towards the lows as that unfolds. That's the Dow, the S&P 500 off 1.2%, similar action there, and the NASDAQ Composite down 1.3%. We're going to dig more into this in a moment, but I do want to point out what is happening with oil because that's where we have seen a lot of action today. Huge gain in oil prices, up by some 8.5% for WTI and just under $74 a barrel. Let's dig into all of this and all of the repercussions right now. I'm joined by Yahoo Finance's Josh Schaefer, Inez Ferre, and Ben Werschel to break down all the latest news and movers from today. We're going to start with Ben. So talk to us about what we're hearing from Washington as we see the events unfolding in the Mideast, Ben.
Yeah, so this is a fast-moving situation. As you notice, there's been media reports just in the last couple hours of new explosions, both on the Israeli and on the Iranian side. So this is an ongoing situation, and both sides are suggesting Iran in terms of retaliation, Israel in terms of of continued attacks, suggesting this isn't going to go away. Here in Washington, the stance from President Trump, so far at least, has been to say we're not involved in this. The U.S. has incredible interest in this, obviously, from U.S. military assets, from U.S. civilians, and especially a keen interest not in avoiding oil price instability. But for now, Trump's main message here is that Iran needs to make a deal here to avoid essentially further destructions. The economic bottom line here question is are these oil questions? The analysts at J.P. Morgan outlined what they're calling a worst case scenario here, basically much worse than things are now if things continue to escalate. And that can mean we're talking about 5% inflation. The question is whether we get closer and closer to that, and that changes the calculus for the U.S. side as well as the Iranian and Israeli side.
Yeah, as we know, President Trump has really wanted to keep those oil prices and therefore gasoline prices low to give him some sort of leverage here. So let's get to Inez now, because you've got the oil angle. We have been seeing this surge in oil prices. What are we seeing now? What are you hearing in terms of commentary?
Yeah, Julie, what we're hearing now is really that risk is the story when it comes to oil prices. You are seeing oil up 8% right now after that Iranian retaliation on Israel. But the question here is, how long will this last? How long will this conflict last? Some analysts are saying that this appears to be a little bit different than other attacks in the past, because this isn't just a one-off. This could really last a long time. And the word act of war has been mentioned. So the question is whether other countries will be dragged into this, and or if the Strait of Hormuz will be closed down. That's where 20 million barrels per day of oil products go through that area. But analysts are saying that they don't anticipate that Iran will do that, because that would irritate one of their biggest customers, which is China. So it's not in Iran's best interest to do that. Also, no oil infrastructure in Iran has been targeted that we know of yet. So Iran is the third largest producer among OPEC, the fourth among OPEC Plus, more than 3 million barrels of oil per day that they produce. About 1.8 million barrels per day of are at risk of not being exported. But analysts are saying, look, even if we do see these extreme scenarios where we're looking at oil at triple digits, you are still going to see it coming down because of more production outside of shale, and also just simply because of demand destruction, because you will start seeing demand destruction if oil gets high enough.
So that implies then that this upside would be kind of limited if we look over the longer term, right, Inez?
That's right. Limited upside. And in fact, JP Morgan and also Goldman Sachs, they have talked about higher oil prices in these extreme scenarios, but they're still seeing Brent coming down into the 60s in their base case. Of course, a lot is depending on what happens with this conflict.
Of course. And then let's get back to some other assets that we're watching, because we've got stocks overall, as I mentioned, sinking to the lows of the session. Josh, you're here with me on set here. And it's really tough to parse geopolitical conflict from the stock perspective, right? Because we tend to see like a blip and then a quick fade.
Yeah, normally you would see sort of maybe even stocks rally into the close potentially off this, right? At some point, stocks would recover. We thought we were seeing that maybe earlier this afternoon. Then you mentioned, of course, the conflict escalated again. So what you're seeing right now is really just classic risk off in the markets, right? You have all three major indexes down. You flip over to the Treasury market. You're seeing bonds or Treasury yields are rising, right? That 10-year now up about 6 basis points on the day. And then you flip over to sort of what that means for markets and what's moving up and down. Energy is up. It's the only sector in the S&P 500 that's up right now. And then the Russell 2000, which had been catching a bid for most of this week as rates were falling over the last week, is now actually down about 2%. That's one of the biggest laggards in the market. So what you're seeing is just a little bit of a reversal of what the trade was this week, which was hopes for Fed rate cuts. Rates are coming lower, a little bit more risk on in markets. Today, you have those inflation fears that Ben mentioned with the potential spike in oil really taking the driver's seat in the market and weighing on stocks.
Yeah, I mean, it really does seem to hinge all on oil. I've been looking at various commentaries today. Peter Bookvar, longtime strategist, writing in his daily note, historically, major geopolitical events such as this have had a fleeting impact. And we, of course, hope, again, this is one of those times. So if you look at the VIX, and you compare this, as Bloomberg did earlier today, with what we saw last year when we saw Israel hit Iran, you saw a little bit of a blip in the VIX. And today it's trading above 21. So we're seeing a blip similar to that. Whether it will be lasting does indeed seem to hinge on those oil prices. And Inez, I was struck when you talk about the Strait of Hormuz, as you mentioned, JP Morgan really emphasizing if Iran does close it, it's never done it before. So they don't think that it is terribly likely that we will see a total shutoff for the reasons you iterated, that this would anger some of their biggest customers, for example. But you have to expect that there could be some level of disruption, even if Israel is not hitting those facilities directly.
Yeah, that's right. And there are analysts that are talking about slowing down of oil products through the Strait of Hormuz. So even though you may not shut it down completely, you still would have an impact if there is a slowdown. And we certainly have seen times when we have seen attacks in the area, et cetera, and that has sent the price of oil higher. But the bottom line is that these analysts are saying Iran would not want to do this. It would irritate other oil producers and, again, China.
And then, Ben, if we do see oil prices, even if they don't go up that much more from here, if we do see this elevation, if we do see it feed through to gasoline prices, you have to wonder what that's going to do for the tariff negotiating power. I mean, you wrote about this. You've been talking a lot about so-called Liberation Day 2.0 upcoming in July. And if oil prices and therefore gasoline prices are elevated, what is that going to do to those tariff negotiations?
Absolutely. This will have this is what it would have a direct effects on these tariff things, as you mentioned, because inflation is essentially the central Trump case as to why he can do tariffs. You saw it earlier this week. You saw kind of a cooler than expected inflation print that was pulled down by lower energy costs, that was followed by new commentary from Trump about tariffs and about moving forward with tariffs on this Liberation Day 2.0. So it definitely complicates that. There's definitely been analysts today who have talked about how this could put pressure on Trump to not do as many tariffs in early July as he might have had planned. So it's definitely going to complicate that. One more I'd add is it's going to complicate things with Jerome Powell as well. This is another storyline we've seen in Washington this week where Trump and Powell have been at each other, or Trump at least has been at Powell in new ways, and a new energy uncertainty complicates things for both Powell and for Trump in that side. It
also complicates things for all of us who are driving and, filling up the car. And Josh, I find it interesting, all of this happening against a backdrop of another strong reading on consumer confidence, the strongest since January of 2024, that all else being equal, if this wasn't unfolding in the Mideast, maybe would have sent stocks higher today.
Definitely, Julie. I mean, it felt like this week and the sum of economic data that we've had over really the last 2 weeks now, right? You go back to that May jobs report that was relatively strong, maybe some weakness in the details, but relatively strong. You had a consumer price index report this week that showed tariffs aren't really weighing on inflation at the level that Wall Street had feared at this point. And then you have sentiment starting to rebound. That soft data, the survey data that we've been talking so much about, also starting to come back. Inflation expectations coming down. There were a lot of solid developments for the fundamental story for stocks. But as Bank of America's chief investment strategist Michael Hartnett pointed out in his note this morning, it feels like the door is wide open for bulls unless oil prices keep moving up, right? And so that had been a trend we were watching earlier this week, exacerbated today, and weighing on stocks, at least for the time being.
Yeah, feels like it's all about oil. Josh, Ines, Ben, thank you all for the team coverage. Josh, you're going to be back a little bit later. Let's get some more perspective now on what all of this means for investors moving forward. For that, we've got Jason Pride, Glenn Mead, Chief Investment Strategy and Research. Glenn Mead, by the way, has over $45 billion in assets under management. Jason, it's good to see you. So how are you thinking about all of these issues that we've been talking about? As we mentioned, geopolitical risk does not tend to have a lasting effect on stocks. However, if oil prices are going to stay elevated, well, then what is that dynamic then going to create in terms of a ripple effect?
And I do think that that's actually how investors have to approach this. You need to realize that at any given point in time, you do need to manage risks in your portfolios. And one of the things that you can do to manage risks is, properly align your investment portfolios with your goals and interests so that when you hit difficult patches, you're able to pull from the more defensive portions of your portfolio for spending needs and not touch the riskier portions. Because the reality is the riskier portions, your equities, are the things that are going to get hit, broadly speaking, when there's a rise in geopolitical risks. There's another thing that we need to consider for geopolitical risks, and that is those items that are closer to the fray tend to get hit the most. Now, fortunately for a lot of kind of global investors, your exposure to Israel and Iran tends to be relatively small in portfolios, and therefore the direct linkage is a little bit looser. U.S. and other nations are obviously relatively distant from the actual conflict at hand. But then, as you mentioned, you kind of have to look over your shoulders for second-order effects. And second-order effects of higher oil prices feed into higher inflation, put the pressure on the Federal Reserve to keep rates a little bit higher. That can cause a little bit of difficulty on a near-term sense, and you need to be looking over your shoulder for that. We don't think that that is a reason to, in reaction to events as they're unfolding, change your investment plans in a dramatic way. In fact, we'd really caution against it because quite often We think that things are getting worse or bad at a time when it relates to international conflict, but international conflict is actually very, very difficult to predict. And we would argue that, well, there's a lot of pundits out there that want to try to tell you exactly where it's going. Their likelihood of being accurate on that is very, very low.
Well, okay, all of that, absolutely fair. None of us knows what's going to happen. But when you're looking at your portfolio, not necessarily in a reactionary sense, but how do you want to think around the role of things like gold and things like treasuries or even things like oil as you see things like this unfold? What do you want your exposure to be in some of these areas?
So first and foremost, because of that balanced nature of your portfolio, you'd prefer to have a fixed income portion in your portfolio in order to act as a ballast during the difficult times. The second thing that you want is you want international diversification. A global portfolio will own things that are not just in the area of conflict, but will own things elsewhere. And things elsewhere away from the conflict will probably do a little bit better at that point in time. Now, as it turns to gold and oil, there's kind of two thoughts and approaches here. Number one is that gold is a very imperfect hedge for inflation that's particularly related to the energy markets. Having said that, energy commodities or oil commodities are actually also kind of a suboptimal investment. So that's not something we tend to advocate. If anything that you would consider as an investor, we'd consider investments in the equity space and the energy space to try to benefit from those higher oil prices. And that is one way to diversify your portfolio in this environment on a longer term sense in the face of these issues. Again, there's no real perfect tool on this other than, we think, a little bit of fixed income exposure and diversification of your portfolio.
And of course, there's a lot of other things going on besides what's now unfolding. We have the trade negotiations that are continuing. We have the Fed meeting next week and sort of largely expected to continue to be in that wait and see mode. And so do you sort of apply that same playbook to some of these other events where we're not quite sure how it's all going to play out?
We do to some degree. Generally speaking, our perspective on the tariffs and this very large fiscal bill that's coming through, you can actually start to read the tea leaves just a little bit on that. The tariff negotiations, we think, by our estimation, are probably going to have about a 1 to 1.5% headwind to economic activity in 2025. But majority of that's actually going to be felt in 2025. This fiscal bill that's coming, interestingly, the contours of it looks like it's going to be marginally stimulative to the tune of about 0.5% per year over the next 10 years. But that stimulus is going to be concentrated in the first 4 years. And that concentration in the first 4 years will mean that there will kind of be an equal and opposite stimulus benefit from the bill coming in 2006 primarily as an offset to the tariff policy. The interesting contrast here of timing is a little bit of softness in 25 and perhaps as an acceleration in 2026. And we'd be a little bit surprised if markets didn't catch on to this as we head into the beginning of next year and actually heat up a little bit as a result of it.
And do you think we'll be getting a couple of interest rate cuts from the Fed in the meantime?
If our base case plays out, we're probably in the camp of about one interest rate cut for 2025. 1 to 2 in 2026, so a little bit slower of a pattern. And that's on this presumption that the tariff policies, the negotiations go somewhat well to get to our base case. And this fiscal bill comes through with this front-end loading of stimulus that we think the market and investors and a lot of business leaders will start to recognize coming into the start of the year.
Jason, thanks a lot. Have a great weekend.
Thank you. Thanks for having me.
We're just getting started here on Market Domination. Coming up, card providers like Visa and MasterCard are dropping today. I'll tell you why and get you caught up on some of our other top trending tickers. Plus, the FOMC's June meeting kicks off on Tuesday. We'll preview what to expect from Jerome Powell and company later in the hour. Stick around, much more Market Domination still to come. Escalating tensions in the Middle East shaking global markets, with U.S. stocks sliding as investors lose their appetite for riskier assets, at least for now. So how does this translate into the options market and volatility? Here to discuss All-Star Chart's chief options strategist, Sean McLaughlin, as well as Yahoo Finance's Josh Schaefer back with me. And Sean is here with us at the studio, which is a nice treat.
It's great to be here for the first time. This is a beautiful place you guys have.
Thank you so much. Appreciate it. So let us talk about the VIX and volatility, because we are, not surprisingly, seeing it spike today on these headlines coming out of the Mideast. It's at about 21. Is that pretty typical now for what we see around these sort of geopolitical conflicts flaring up?
Honestly, last night when I saw the way the S&P futures were trading, I expected a bigger move in VIX. So seeing a VIX in the low 20s right now, I don't know, that doesn't raise the alarm bells for me yet. Now, this is how VIX spikes start, right? They got to start somewhere. And the next few weeks, and we have a weekend coming up, but Monday we could wake up to a VIX in the high 20s, maybe higher. I'm not saying that's going to happen, but I'm not convinced yet that the market is spooked, really spooked yet.
How does it translate to options trading specifically, right? To have a big volatility spike. Obviously, I think you're probably not planning for that necessarily, depending on where you're placing those positions, right? So like the past month and a half, when we've had several of these events, how does that sort of impact the strategy?
Well, it impacts how I will trade going forward, right? So when volatility is high, as an options trader, I want to start putting positions on where I'm selling premium. I want to be short premium, generally speaking, when volatility is high. Now, I don't want to sell high. I don't want to be selling premium as volatility is rising. I want to wait for volatility to roll over a little bit, because as we've seen, a VIX can go from 25 to 30 to 35 to 50 really quickly. And if you're on the wrong side of that, that can be painful. Now, as an options trader, we have the ability to define our risks and put ourselves in a position not to get burned if we're wrong. But I still like to wait for, see a day or two of VIX closing lower and then start positioning against the volatility.
So you're not chasing on, say, like you said, maybe Sunday night, Monday we come in, the VIX is significantly higher. You wouldn't prefer to chase on Monday when the VIX is still spiking?
No, because as we've seen, when VIX spikes, it spikes fast, right? And then when it rolls over equally fast. So I'm kind of waiting for the rollover, and then I'll start making trades, betting on a volatility contraction, maybe selling put spreads in the SPY or the QQQ, indexes like that.
Okay, I'm going to ask a dumb question. What does selling premium mean?
So selling premium means I want to be collecting money for selling options. So instead of buying options where it costs you $1 a contract or $2 per contract, instead you're taking the other side. You're selling it, you're going short, and you're getting paid first, and you're betting on the value of that contract, whether it's a call or put, going down in price, and you're buying it back at a cheaper price.
Okay, so I'm interested in one trade that you told us that you're putting on right now, which it's on the SPY, and it's a call calendar spread that effectively says you think that the SPYs are going to get back to all-time highs over the summer, right?
I do think so. I've been talking with my analyst team over the last couple of weeks, and I feel like we've come back so far to not get there. I mean, what are we? We're a whisper away from all-time highs now. We're a good afternoon away from it. To not get there from here would be, I just can't even imagine that. So yes, it doesn't surprise me if we chop around here at these levels for a little bit, especially with the geopolitical stuff going on. But for me, I got to believe that by 4th of July, we can make a new all-time high. Now, when we get to a new all-time high, anything could happen from there. We could just have a runaway gap that everyone's just chasing and they can't get in, or it could be a big rug pull, and then who knows?
Well, because right after July 4th is July 9th,
right,
which is the next tariff deadline.
Exactly. So it wouldn't surprise me at all to see the S&P and the NASDAQ get to new all-time highs in the week or so before that, and then the real fireworks happen.
Yeah, I actually want to bring up something that Binky Chadha of Deutsche Bank talked to us about the other day with how he thinks about the tariff back and forth and the trade back and forth. He said basically what we saw is what we saw during the last Trump presidency. When stocks go down enough, the administration reacts by sort of backing off on trade. So if we do, and then the opposite happens.
Sure.
So in other words, if we get to record highs again and Trump is
Turn the
feeling
dial
good
up.
going into July 9th, maybe then we could see something that the markets are not going to like as much and things go back down.
It's funny you say that. I had the same thought this past weekend. It's interesting how when we're at the lows, we got the administration trying to pump everybody up and give good news. If there's any news at all, it's good news, right? But they're going to stay away from the bad stuff. And yes, it totally makes sense that we're right back at all-time highs. People are feeling good about their finances. They're feeling, okay, we're back off the brink. Okay, now we can start trickling out some tough stuff, some tough love, right? It makes sense to me. It's not the way I grew up following politics, but that's the way it seems to be these days.
Well, one of the other interesting things that's been going on over the last month, too, that I've been following is just the correlation between how stocks are moving, right? In early April, market was all kind of moving together, right?
Yeah.
All the stocks were moving together. And I guess I sort of wonder if we approach July 9 and get back to that sort of scenario, because stocks have kind of, that's split now, right? We haven't had a correlated market.
Right.
What if that happens again in July 9, and then how does that sort of impact whether you're putting options on certain individual stuff? Like, how does that impact how you'd individually trade stocks if there's concern that we would get back to a market where, Trump tweets and everything moves?
Yeah, I mean, markets tend to get to a correlation of 1 when people are scared, right?
Sure.
Everything trades together. Everything trades down together, and everything bounces together. So for me, if that happens, if we're in a high correlation market, it's because the market's scared. And we're going to be selling off. The VIX will be spiking. We'll be looking at high premiums again. When we have volatility spiking, what I tend to look for, and I looked for this in April and it worked out really well, knock on wood, but soon as the S&P started bouncing and the VIX rolled over pretty good, then I started selling QQQ put spreads, NASDAQ put spreads, and I was selling, selling a put spread, meaning I'm selling just slightly out of the money put and then protecting it with a further out of the money put. So it's defined risk, okay? So I know the most I can lose and I'll size my position accordingly. And I'm betting on 2 things, and I'm betting on 2 things, and I could win if one or both happen. And that is, I'm betting on volatility contracting, or I'm betting on the lows holding. No lows not breaking. If I get one of those 2, I'd probably make money. Certainly, if I get both, I make money. But my risk is defined, and that's the most important thing.
I want to ask you about a single stock trade that you are looking at also, and that has to do with Take-Two Interactive, the video game company. Josh talking about things not correlating as much probably gives you more opportunity too.
Absolutely.
On a single stock option basis. So what are you looking at with Take-Two?
So with Take-Two, that's a software company that if you look at the chart over the last year, it has been one of the outperforming names. It has been riding its 50-period moving average almost without fail, and it's recently come back and tested that a little bit, and it's moving its way back up. And it's one of those names that it can move $20, $30 in, once it breaks through new highs, it could get there again in a month or 2. And I'm looking at a September call spread. I want to buy I think it was the 250 calls and sell the 270 calls. I could get it for around, I think I looked at $5.50, maybe $6. I could triple my money if I get it right. And define risk.
Sean, I'm not a technical analyst, but even I can look at the Take-Two chart and understand sort of what you're looking at there, right? Some higher highs.
Number go up, collect.
I have an 11-year-old son, and I tell him, look at a chart. Like, what's that chart doing? He says, it's going up. Well, those are the kinds of stocks
Those are the things you buy, right?
Yeah. Sean, thanks so much. It's
Thanks
good
for
to
having
see
me.
you. Thanks for coming in.
Awesome.
Appreciate it. Now, time for some of today's trending tickers. We're watching shares of major card providers falling while Whirlpool stock is rising. Let's start with those card providers. Visa, MasterCard, American Express, they're all falling. That's after a report that Walmart and Amazon are exploring the introduction of their own stablecoins. That's according to the Wall Street Journal. Those retailers looking to implement new currency forms to depend less on traditional fund transfer infrastructure, to streamline global payments, to lessen processing fees. And of course, those fees are how Visa, MasterCard, and Amex make their money. The introduction of these stablecoins could hurt their bottom line. Now, all of this is just reportedly theoretical. Josh is still with me here, and the Journal makes it clear that they're sort of exploring this. They've reported that major banks are exploring this as well.
Stablecoins are hot right now, right?
Look at the Circle IPO.
Yeah, exactly.
Right?
It just feels like, I don't know, you get into these little moments where every now and then it's like, what's the thing we're doing right now? And it's like, okay, we're doing the stablecoin thing. Everyone needs to talk about their stablecoin strategy now. I think for the payment companies, though, Julie, it's interesting to me because there's a consumer side to this, too. And yes, this is a little anecdata-y, but are we really going to change how we want to buy everything? Are we that upset with the payment process right now? And would consumers push back?
We're not upset.
Yeah.
The merchants are upset. They don't want to have to pay the fees. And this applies, by the way, to a lot of small businesses as well. So it would be really interesting to see, I don't know about you, when I go to get my coffee down on Astor Place, you pay less if you pay in cash because they're passing on, in some cases,
they don't want to pay
those fees to you. They want to get tipped in cash as well, et cetera. So, small merchants seem to have the most to gain potentially from this kind of things. But if Walmart and Amazon are doing it, would those merchants get shut out from this kind of a system as well? There are a lot of questions, is my point. But a lot of it hinges on this so-called Genius Act that's making its way through Congress, which would put rules around stablecoins. And presumably, if that does end up passing, that's going to be the trigger that then would get the banks and the retailers and whoever to get more serious about all this.
Yeah, it's just interesting to me because it seems like something that would take quite a long time. And I saw some folks in the analyst community pointing this out too, specifically with the 5% drop in Visa, which if you were bullish on Visa a week ago, is this really a reason to necessarily get long-term bearish? Perhaps not. Just thinking about the infrastructure of how payments continue to change, but then Visa and MasterCard kind of always continue to be in that conversation, right? I'm using tap to pay on my phone now to buy something, but Visa is still benefiting. Like, they've slowly been a part of all of these changes. So could they also be a part of the stablecoin change too, right?
According to an analyst over at William Blair, Andrew Jeffrey, they could. He says Visa and MasterCard are building stablecoin infrastructure that can support commerce on their rails. And he says he doesn't believe stablecoins are well suited for business to consumer commerce. So, in other words, still a lot.
I got to learn more about stablecoins. We lost the penny. We're replacing it with stablecoins. It's a new world.
It's sort of simple and sort of not.
Yeah.
It's sort of like $1 per stablecoin, but you don't have to worry about the back end.
Yeah. I like cash. It's easier.
Sure. All right, let's talk Whirlpool. Those shares are rising after it got a new rating from Bank of America. Analysts changing the appliance manufacturer from an underperformed to a neutral, citing the company benefiting from import tariffs that will hurt competitors' costs. The Trump administration added home appliances to steel tariffs, putting a 50% duty on the value of steel used in imported goods. And so basically, Bank of America is saying Whirlpool makes a lot of their stuff in the U.S., so on a comparative basis, they're in a better position.
Yeah, I mean, this has been the tariff story that we've talked about on an individual stock basis consistently, right? Someone wins and someone loses from every piece of any sort of legislation that's coming in, right? Any sort of policy. And I thought B of A pointed out a great point here. 80% of Whirlpool's U.S. sales are manufactured domestically, with 96% of steel from the U.S. They're just simply not exposed at a level competitors would be. Then if they don't have to raise their prices the same way that competitors would, I don't know about you, but I'm just probably going to buy the cheaper item, right?
Of course, especially if you feel like you're getting as good a thing. And if Whirlpool can market it as made in America, for example, even better for a lot of customers right now.
That seems to be a big push right now. We want more things made in America.
Yeah, exactly. Thanks, Josh. It's been an encouraging week for economic data, with inflation showing signs of moderating and consumer sentiment rebounding for the first time this year. The labor market remains broadly stable as well, although a recent uptick in jobless claims does suggest some signs of cooling. Altogether, the backdrop appears supportive of the Federal Reserve's path toward easing at some point. But Wall Street watchers say policymakers might need more convincing. Yahoo Finance senior reporter Ali Canal joins us now from the NASDAQ with more. Hi, Ali.
Hi, Julie. That's right. The Federal Reserve is expected to hold rates steady at next week's policy meeting, although nearly 70% of investors now believe cuts could come by September, and some are even betting on July. Still, uncertainty remains, especially around the scope of President Trump's tariffs, which continue to ripple through markets. Some duties have been paused, but many remain in place, and we still don't have a firm deal with China, which is one of our largest trading partners. All of that complicates the Fed's outlook, and we did have the chance to speak about this with Wall Street watchers this week, including a former Fed president. Take a listen.
The high level of uncertainty still is with us, and that, I think, is why the Fed is on hold until some of that we get a little more clarity about not only the magnitude of the tariffs and the breadth of the tariffs, but what effect they'll have on inflation, and what effect the tariffs and other policies, including the budget bill, will have on growth and employment.
The Fed is going to stay on the sidelines, which means we're kind of in this wait and see time period. And that's where I don't think the Fed likely cuts until September, unless you see significant weakening in the labor market. And then the question is always, is it too late or not?
The benign version of rate cuts, I think, will take time to develop because the Fed will want to have confidence that, number one, prices aren't rising, in a kind of uncontrolled fashion. And at the same time, the Fed will be monitoring the activity signals in the economy as well.
So for now, the general consensus is that the Fed is staying cautious, encouraged by the data, but waiting for clearer signs before making any significant moves. And we'll be watching closely for what comes out of the updated dot plot as well, which will give us more of a sense into how the central bank is thinking about future interest rate cuts. Julie?
Thanks, Allie. Well, coming up, the Federal Reserve is likely to hold interest rates steady at next week's June meeting, but what could the updated dot plot look like? That's where the suspense lies. We'll preview what to expect from Jay Powell and company on the other side. Stick around, much more market domination still to come. The Federal Reserve likely to hold interest rates steady at next week's June meeting, but we are expected to get an updated dot plot on Wednesday. For more on what to expect from that upcoming Fed meeting, let's welcome in Yahoo Finance's Jennifer Schonberger. Hey, Jen, how are you? What are we looking for?
Hey, Julie. I mean, has it been 6 weeks already? Because I feel like I just blinked, and here we are, another Fed meeting. The Fed widely expected to hold interest rates steady next week, but investors are going to have their eye on something else, whether policymakers retain expectations for 2 interest rate cuts this year. And many Fed watchers expect the Fed will stick with 2 cuts as they weigh so many unknowns, from whether tariffs will push up prices or push down growth to geopolitical risk. Former Kansas City Fed President Esther George told me, given just how fluid things are at the moment, she predicts that they'll be reluctant to signal changes from where they were earlier. She says they don't want to shake markets and cause people to think that things are going to be tighter for longer. President Trump, of course, has been hammering the Fed and Fed Chair Jay Powell to speed up the timetable for any rate cuts, most recently citing milder inflation. But Powell and many of his fellow policymakers have made it clear in recent weeks that they're still more worried about the risks of higher prices from Trump's tariffs than any risk in unemployment, as they weigh both sides of their dual mandate. Adding to that, the impact of Israel's strike on Iran and whether a protracted war could lead to higher oil prices and inflation this summer. Fed watchers note that the job market, although it has been cooling, isn't showing any cracks, with the unemployment rate holding steady at 4.2%, a historical low, while wages are growing at nearly 4%. Investors currently betting that the Fed is not going to cut rates until September, but many I talked to say the Fed ought to leave the door open for a rate cut in July, lest they box themselves in like they did last summer, where they took July off the table during the June meeting, only to find themselves having to cut by 50 basis points in September. Julie?
Yes, and Fed critics will always say that they're too late or too early,
Correct.
So we'll see what happens this time.
There is always an opinion, right?
There it is. Thanks, Jen. While mortgage rates hold steady for another week, affordability does remain a pain point in the housing market. Our next guest pointing to a mixed picture in leading indicators for demand. That's Jim Egan, Morgan Stanley U.S. housing strategist and co-head of securitized products research. Jim's here with me in the studio. Thanks for being here.
Thank you for having me.
So given that we have not seen that much movement on rates, and notably not that much relief on rates, do we remain in this sort of stuck place in the housing market?
I think for the most part, we're locked in and priced out from a housing market perspective, but I do think there have been some interesting developments in terms of how different parts of the market have evolved over the past few months. For instance, to your point, affordability, incredibly stuck, and you're seeing sales volumes, existing home sales volumes, having trouble kind of picking up as a result of that. First 4 months of this year, existing sales volumes are down about 2% versus last year, effectively flat, down a little bit, but that means that this is the fewest number of sales through 4 months of the year that we've seen since 2009, which is never really a year you want to compare the housing market to.
Well, we're not seeing any other comparisons, though, to 2009. In terms of, I mean, you've really got your eye on where there were signs of strain in that period of time. That's your where your business lies. And I don't think anybody is worried necessarily about a repeat of that situation.
Not even close. There's a whole host of reasons why we can talk to that, but the biggest piece here is that locked in part of this, right? Rates are incredibly elevated. We're at 6.8%, give or take, from a prevailing rate perspective, which means that the homeowner with a mortgage rate of about 4.05%, they're locked into that home. So sales are down, but inventories are down as well. Now, inventories are picking up a little bit here, putting a little bit of downward pressure on year-over-year price growth, but it's pressure on price growth. We're still seeing home prices climb because you have this incredibly locked-in supply environment.
So is the real pivot going to be rates? Is that kind of the thing that needs to change, or are there other things that are having an effect too?
So there's a few different aspects to the housing market right now. We're talking about the existing inventory piece of this and the lock-in there. When you talk about supply shortage in housing, it's not just existing, it's the building piece of this. And when we think about how housing statistics have evolved so far this year, the one that's down the most, at least the one that we look at that's down the most from 2024, is single unit housing starts. We're down about 7% year over year from the first 4 months of 2024 to the first 4 months of 2025. And we think that we're in a conservative place, at least 1 to 1.5 million units underbuilt. We can be more aggressive with that estimate if we want to. And that's something where the impact of tariffs, raising cost of goods, that plays a role in terms of potentially bringing down, we've seen builder confidence come down, bringing down the single unit start piece. That lack of supply, that provides support to home prices, just like the lack of listings from an existing inventory perspective. But when it comes to a catalyst to really get this going again, we do think that those mortgage rates, bringing the affordability, we're better than we were in the fourth quarter of 2023. Still more challenged than we've been at any real point in the past 40 years.
Yeah.
But getting that to a point where people are more comfortable listing their homes, and some of that, what we believe pent up demand on the sidelines, is more willing and able to step in on the buyer side.
And so are we going to see any change on that front? Are you optimistic that with a Fed rate cut at some point, maybe this year, that we will get some level of relief in mortgage rates?
So we just went through our whole 12-month ahead outlook process at Morgan Stanley Research, and our economists think you're going to have a little bit of upward pressure over the next few months from inflation as a result of the tariffs. We think that's going to create a pretty difficult environment for the Fed to cut in 2025. So we don't see a lot of relief on the mortgage rate front this year, and especially not over the course of the next 3 to 4 months. We think we're kind of, the title of the housing outlook piece was going nowhere fast. And so we think we're kind of stuck here right now. We think there's a lot of support to sales. They're down a little bit, but there's some level of housing activity that has to occur regardless of where affordability is, regardless of where mortgage rates are. Think of it as people that need to move for work, people that have growing families, those household formations as people move through their 30s. So we think sales volumes are effectively supported here. Moving into 26, that's when we do think you can start to get a little relief for a handful of reasons, including the market starting to price in a few more Fed cuts as we get into that out year, if you will, where we could see a little bit more acceleration on the demand side.
All right, something to look forward to at least. Thanks so much, appreciate it.
Thank you for having me.
Look, coming up, we're brewing up a look into how AI is making a splash in the coffee business. More market domination on the other side. From an AI-assisted barista to protein in your coffee, it's been a busy week of announcements for Starbucks, but will all of these new bells and whistles drive up foot traffic? For more, let's welcome in RJ Hadavi, Placer AI, Head of Analytical Research. Placer AI analyzes foot traffic trends, and RJ happens to have been an analyst covering this industry in a past life. So RJ, it's good to see you. Great to have your expertise on this. So Starbucks held this big leadership conference at the Sphere in Las Vegas this week. They made a bunch of these announcements. So I guess I would ask sort of one by one. I'm curious about the AI piece, because effectively it sounds like a barista has a question about ingredient, about a recipe or something, and they can call up in an iPad an AI assistant who's going to help them. What do you think this does ultimately for traffic, for how things work in a Starbucks?
Yeah, I think it's going to be interesting to watch, because we haven't seen something like this on an AI deployment on a widespread scale, at least the size and scope that Starbucks has. There's been a couple other retailers that have done very successful things to help educate and inform their employees. Tractor Supply is a name that comes to mind. But it'll be interesting to see. And I think the key goal here is unlocking throughput capacity. I think Brian Niccol, the CEO, has been very upfront about some of the capacity constraints they have at their restaurants, getting people through the line quicker, improving that experience, bringing it back to that coffee house feel. And I think this could be helpful. I mean, there has been a lot of complexity added to the menu. Ultimately, they are paring back on the number of products that are there. But I think for the products that they continue, there's still a level of complexity. And I think this could be an interesting solve. I do think that, like any technology, there will be an implementation phase. But I'm interested to see what it will do. If that can get people through the door quicker and through the line quicker, that would certainly be positive. And one of the goals is to bring down speed of service.
Yeah, definitely. I mean, anecdotally, all of us know that we've been in Starbucks before where you got to wait quite a while to get your order.
Yeah, exactly.
What have you guys been seeing in terms of traffic trends at Starbucks? Have you seen that evidence that customers are getting frustrated and not going in as much because they don't want to wait?
Yeah, what we've seen with our data is really Starbucks, the biggest issue they have to face is visit frequency. The number of visitors coming in compared to a couple of years ago is pretty similar. It's down a little bit, but pretty similar to what it was a couple of years ago. Where the company's been challenged is more on the visit frequency, getting people to come as often as they once did. I think people are finding other coffee chains, finding other substitute beverages, maybe brewing coffee at home, ready to drink at home. Getting people back into the Starbucks and making sure that there's that consistency of experience, speed of service, that's the biggest thing. So looking at the recovery right now, our data suggests that Starbucks is roughly running about flat in terms of year-over-year traffic growth. So I think it's still a little bit of a work in progress. Some of the back to coffee approach, that's a back to Starbucks approach that Brian Niccol's putting in. But I do like the fact that they got a good foundation to build off of, that the number of visitors going in is pretty consistent. And now if we can start to improve that experience and just get them in more frequent, I like that's at least where the turnaround is starting from here.
And okay, so part of it is improving the experience of going into a Starbucks. And then also part of it, as we know, is what people are ordering and what they're being offered when they go in there. So it seems like that Starbucks is jumping on the protein bandwagon, which is in some measure GLP-1 driven, right? More people turning to those kinds of protein things. And there are other coffee chains. I think Dutch Bros already has some of these protein offerings. So I don't know if there's a compare and contrast, if we have some evidence to see that this kind of stuff is really working for other places.
I think what we've seen, certainly for Dutch Bros, is one of the elements. They've been one of the leaders in terms of year-over-year visitation trends, not just because they're opening up more locations, but on a visit per location or comparable visit basis, they're doing a very good job. I think the key message here is innovation. They're moving away from the value focus, the discounting, which I think is something we've seen from a lot of restaurant operators, but it tends to be more of a temporary lift. It brings in kind of that occasional user, but they don't come back at that visit frequency. Now we're seeing it kind of dialing up on the innovation front. And I think that is kind of the compare and contrast here is let's compare some of the innovative things that Dutch Bros has done, but do it in kind of a Starbucks, under a Starbucks lens, do it to things that are a little bit more consistent in the coffee house feel. So I think this, the protein, the banana foam that they're going to put on could be an interesting way, because I think that will track kind of the, dietary trends that are out there, but do it in a way that could promote that visit frequency that we just talked about, get people coming in more often. It's something that will certainly pique some curiosity. People want to try it out. And if they feel there's a health benefit, that's the kind of thing that does tend to drive more repeat visits as opposed to discounting, which the company experimented with this time of last year. I think that is the key thing here, is that they're starting to lean in more towards innovation than they are the discounting side of the equation.
And then RJ, lastly, I want to ask about number of locations, because apparently the company plans to add another 10,000 stores in North America over time. It feels like we got an awful high number of Starbucks already. So what is that going to mean for traffic?
I think what's really interesting about this too is that does seem like a lot of locations, but if you look at migration patterns across the U.S. and where our data suggests people are moving to, we've seen this movement away from big cities to more suburban and rural location. And I think Starbucks sees this as well. I think this gives them the opportunity to go after that audience that may have moved away. And frankly, we're actually seeing their Starbucks stores in smaller markets see better visitation trends on a per store basis than we are in urban areas. So I think this is a smart thing from the look at. Certainly that's all, seems like a lot. They do, I think, have quite a bit of white space in kind of these secondary markets under 200,000, under 100,000, maybe even under 50,000 in population. I think that could give them nice white space opportunity. The final number is still, I think, going to be to be determined, but I do think that's an interesting opportunity, and I do think that it's a great opportunity for them, although they are not the only ones going after those markets. So that's going to be the one challenge here.
Right, competition. That is really interesting, though, about the smaller markets, those locations doing better. RJ, it's always great to catch up with you. Thanks a lot.
Thanks, Julie. Appreciate it.
Well, we're wrapping up today's Market Domination. Don't go anywhere. We got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.